Do you actively trade in stocks? If you were to sell some of your stocks today, would they generate a loss because they are worth less now than when you bought them? Well, in this episode, we're going to look at how the IRS gives people who sell stocks at a loss a tax break. We'll then look at how using a strategy called tax loss harvesting can save you even bigger bucks come tax time versus just selling off your loser stocks. Ready to get started? Then let's get to it. Welcome to another episode of Minding My Money Mondays, a common sense talk about money matters. I'm Jared Rogers, CPA. If you're new to the channel and never want to miss another money saving tip, then why not subscribe? To do that, simply hit that little cartoon dude in the lower right side of your screen and make sure you hit the bell icon so that you get notifications every time a new video is posted. Okay, so what's this whole thing about the IRS allowing you to deduct stock losses? Better yet, what is this whole tax harvesting thing you're talking about, Jared? Well, as explaining tax can get complicated, I put together some examples to help make this sometimes complex subject hopefully turn crystal clear for you. Let's go take a look.
When it comes to selling stock, there are two key things one should know. The first is that Uncle Sam always wants his cut if you sell your stock for a gain. The second thing is that stock gains are usually taxed at a different rate. Generally speaking, when stock is sold, it's taxed at what are known as capital gains rates. Now these rates, which we can see in the table, are based off of a person's taxable income. The higher your taxable income, the higher the capital gains rate. Currently, there are three capital gains rate brackets, and they are the 0%, 15%, and 20% brackets. These brackets are what apply to any stocks that are held for longer than a year. If you sell your stock within a year, then your gain is considered short-term and is taxed at your ordinary income tax rates. You know, like the ones that you pay on wages, unemployment compensation, and business profits from your self-employed business. So now let's look at a taxpayer under three different scenarios. We'll call them Adam and Eve. Eve is pretty good at buying stock, but Adam, not so much. You see, Eve likes to buy ABC stock, and Adam likes to buy XYZ stock. Eve's stock tends to be on the up and up, and will usually result in gains when she sells it. Adam's stock, on the other hand, tends to be hitting the skids. So it's usually going to sell at a loss if he gets rid of it. In the scenario on the left, we can see that Eve bought her stock for $2,000 and sold it for $3,000. This resulted in a $1,000 gain. Adam bought his stock for $5,000 and sold it for $7,000. This resulted in a $2,000 gain. When you combine their gains, you can see that they add up to $3,000. If we assume their gains are long-term and their income places them in the 15% capital gains tax bracket, we can see that they'll pay $450 in long-term capital gains tax. There's zero tax savings because no strategy is being employed in this scenario. Now let's switch it up and assume that both Adam and Eve have losses. Eve sells her stock for a $1,000 loss and Adam sells his for a $2,500 loss. Combined, they have $3,500 in losses. Now, nobody likes to have losses, but here is where the good news comes in. The first thing is that the IRS will let you deduct your losses on your tax return up to either $1,500 or $3,000, depending on if you file as single or married filing jointly. The second point is that these losses can be used to offset other capital gains or your ordinary income if you don't have any other gains. Now, what happens if your losses exceed the $1,500 and $3,000 limits? Well, the IRS will let you carry over any unused losses to future years. This is what is known as a capital loss carry forward. You can then use those carry forward losses in future years to either offset future capital gains or ordinary income, as I previously mentioned. So in this scenario, Adam and Eve's losses would be capped at $3,000, and they would have a capital loss carryover of $500. Once again, assuming their income places them in the 15% capital gains bracket, we can see that their $3,000 loss generates them a tax savings of $450. Not bad, right? But now let's bring in the strategy of tax loss harvesting and see what that does. Tax loss harvesting is the strategy that involves selling an investment that has lost value, replacing it with a reasonably similar investment, and then using the investment sold at a loss to offset any realized gains. Sounds confusing? Well, let's go through it. Realized gains simply mean that an asset was actually sold. You can't have realized gains or losses until you actually get rid of the stock. So in the scenario on the right, let's assume that Adam and Eve actively looked through their portfolio to see what their stocks had done. Eve has some stock that she can sell at a $1,000 gain. While Adam has some stocks that he could also sell at a gain, he identified some XYZ stock that he could sell at a loss. Now Adam doesn't really want to sell his stock, but he knows that by selling it, he can unlock the losses associated with it. So it's best to sometimes think of tax loss harvesting as simply swapping out stock. You get rid of stock that has losses so that you can use those losses for tax purposes. You then use the proceeds from the sale to either go buy the exact same stock or stock that has a similar makeup. This is so that your portfolio remains largely unchanged or balanced when the transactions are complete. So under tax loss harvesting, Eve sells her stock at a gain and Adam sells his stock at a loss. And they wind up with a total loss position of $1,500. Now Adam is free to go and use the $2,500 he received from the sale to purchase more XYZ stock. However, we're going to talk about a little watch out to keep in mind before he does so as soon as we're finished going through this example. Now since Adam and Eve's loss does not exceed $3,000, there is no resulting capital loss carry forward. Once again, we assume that they are in the 15% capital gains tax bracket. They will pay $0 in long-term capital gains tax, and they create a tax savings of $525. Now, if you're sharp and on your toes, you might be going 15% of $1,500 is not $525, Jared. So explain what type of crazy circus clown math you're using, buddy. Okay, here's the math. If Eve were to sell her stocks at a gain, she would pay $150 in capital gains tax. But Adam sold his stock at a loss of $2,500, which resulted in a tax savings of $375 at the 15% rate. So when you combine Adam's tax savings and the $150 in foregone capital gains tax that Eve avoided paying, that's how you wind up at $525 of tax impact. Pretty powerful, right? The key takeaway is that if you sell stocks at a loss, the IRS is automatically going to allow you to offset other capital gains or your ordinary income up to a certain dollar limit. However, if you have stocks that you're going to potentially sell at a gain and offset them through tax loss harvesting, you not only reap a bigger benefit, but you'll potentially lower your tax bill.
Now, when it comes to tax loss harvesting, the main watch out a person has to be aware of is something called the wash sale rule. Now, what's this? A wash sale is when the IRS says you buy either the same stock or one that is substantially identical within 30 days of you selling the stock that generates a loss. So in our example, XYZ stock sold at a loss in two of the scenarios. Had the taxpayer purchased more XYZ stock either 30 days before or after selling it at a loss, then a wash sale would have been triggered. Now what happens when a wash sale is triggered? Well, the IRS can delay your ability to deduct that loss on your tax return. So it's something that you want to keep an eye on if you're managing your stock purchases and sales on your own. If you're using an investment advisor, many have programs or services that will monitor your portfolio and execute this strategy for you essentially on autopilot. So if this sounds interesting to you, make sure you consult your investment advisor and ask how they can make this happen in your portfolio. In the end, I hope you can now see how tax loss harvesting can not only help you offset your portfolio gains, but it can also help reduce your taxes and make your portfolio more tax efficient. If you have questions that you would like us to answer in a future episode, you can send it to questions@makemymoneymakesense.com. That's questions@makemymoneymakesense.com. So like I always say at the end of every episode, it's been fun, it's been real. I'm Jared Rogers, and until we meet again, let's all continue to mind my money, and I will see you all next Monday. Take care.